The financial crisis, and in particular the Lehman bankruptcy from a year ago, really hit energy companies in the same way that it hit companies in other industries. Principally, it was a wake-up call for Treasury and finance folks to take a look pretty critically at their liquidity strategy, their capital structure, financing plans over the next year or two, and try to think out of the box and go back to the drawing board and say, maybe we should think about things a little bit differently here given what's happened in the financial markets. And that all revolved around a type of cash or liquidity is king type of strategy. And a number of things fell out of that, whether it was cutting the dividend of a company, whether it was cutting down non-essential capital expenditures, whether it was involuntary and sometimes voluntary separation programs, and other things that were all designed to preserve cash. Most companies in the energy space went back to doing back-to-basics secured financings as opposed to unsecured financings because that was the cheapest cost for them. At the same time, that played into investor appetite in terms of supply and demand type characteristics because those investors were looking for more flight to quality type investments. Companies began to be proactive around their refinancing plans. What I mean by that is looking out to 2010 and 2011 rather than waiting until, let's say, debt maturities came due in those years. They were more proactive about going out this year and refinancing those maturities. And there's a phrase in the jargon that's called towers of debt, and they were trying to reduce those towers without having to face in 2010 and 2011 no time, not knowing what the markets were going to be like in 2010 and 2011. I guess the last thing was around revolving credit facilities. That's not typical capital markets debt, but when expirations of those facilities were a year or two out, companies this year would look back and say, hey, let's go out now and try to renew those facilities because it'll be a message to our investors, whether it's shareholders or debt holders, that again, we're safe from a liquidity perspective. When you think about the energy space, there's a variety of ways in which they're going to need capital, whether it's aging infrastructure, particularly with generation facilities, whether that's coal or gas facilities that were built 40, 50, 60 years ago, whether that's trying to increase rate base, which is just a fancy way of saying how can we earn more money on the property that we build and that we invest in, particularly in transmission and distribution lines that bring electricity into everyone's homes, or whether it's trying to comply with environmental standards, which all you have to do is read the papers and see that those requirements are going to be more stringent and stringent. Companies are going to need financing. When I talk about cash as king strategies, there's a variety of ways in which companies can get cash out of their assets, out of the capital markets. There's the traditional ways, some have talked about just going into the markets and raising debt or raising equity. Another one that's a bit more novel, particularly in the energy areas, is the monetization of assets, which again is just a fancy way of saying how can I squeeze more value, more liquidity, more cash, if you will, out of assets that are typically inert and not susceptible to getting that value out of them in the normal way. And to be sure, these are assets that have a tremendous amount of value. We're talking about a transmission system, let's say for a big utility, or even a distribution system. Companies every day now are trying to analyze with the help of investment banks how they can get that embedded value out of those assets, but somehow still maintain operational control. And there's a variety of structures and ways in which those assets can be monetized. Anything that falls out of the traditional, put the plug in the wall and get it from coal and other fossil plants would fall into the alternative energy category. And I think there's dozens, if not hundreds, of companies who over the last 10 years, startups for the most part, have raised seed financing to grow their companies, execute their business plan, build out their technology. And I just have this sense that in the next 5 to 10 years, those business plans have two ways of going. They can either go to the next level, or they're going to be acquired by somebody else, or they're going to have to fold. And the principal reason for that is they're going to run out of money. And so the question is, will the IPO markets, for example, or other venture capital markets begin to open up in a way that really they haven't been for the last 2 years effectively? Will they open up in a way that's receptive to some of the more novel and successful business plans? If they do open up, I think we'll see alternative energy as being a big area that will play in that market. I'm pretty optimistic about seeing that happen in 2010, at least maybe towards the second half, but it remains to be seen. In terms of advice that I give my clients in the energy space, whether it's underwriters or energy companies themselves, it can be summed up by saying be prepared. We're in volatile markets, we're in uncertain times. You can't be stuck in a particular strategy, stuck in a particular timetable.